The overnight session is flashing a massive reversal. It's Wednesday, July 1st, 2026, first trading day of Q3, and the implied open is painting a completely different picture from yesterday's close.
Yeah, it's a violently different tape.
S&P 500 futures are down 0.32% right now, and Nasdaq 100 futures are sliding 0.62%. I mean, we just had this historic roaring first half, right? S&P up over 14%, Nasdaq up 20% in Q2 alone.
Right, but the institutions that drove all that momentum are quietly rotating capital this morning. They are bracing for a reset.
Exactly. So let's look at the data. What is the overnight catalyst driving this pre-market volume?
Well, it's coming straight out of the Middle East. Iran officially ruled out direct peace talks with U.S. envoys in Qatar.
Wow. Okay, so that just completely shatters the fragile ceasefire assumption.
Yeah, shatters it. And it instantly puts the Strait of Hormuz back in play as a critical geopolitical flashpoint.
Right, but I mean, geopolitics usually just gives us a 1 or 2 day pre-market volume spike before the algorithmic trading programs step in to buy the dip. We see those headlines all the time.
Usually, yeah.
So why does today's institutional briefing suggest this specific rejection of talks is going to structurally cap yesterday's tech momentum?
Because the Strait of Hormuz is the world's most vital choke point for global energy transit. When you threaten the physical shipping lanes for crude oil, energy prices spike.
And oil is basically the foundational input cost for the entire economy.
Right. It dictates manufacturing costs, shipping, freight, everything. If energy establishes a higher floor because of conflict, inflation becomes mathematically sticky.
It just stops coming down.
Exactly. And, the geopolitical tension is really just the mash. The actual powder keg that trading desks are terrified of this morning is the macro landscape at the Federal Reserve.
Which brings us directly to Fed Chair Kevin Warsh. He is scheduled to speak today at the ECB Forum in Sintra, Portugal. But the market is clearly still choking on his June debut.
Yeah, because he fundamentally altered the rules of engagement. I mean, at that June meeting, Chair Warsh killed the entire concept of forward guidance.
He literally just ended it.
On the record, he explicitly stated, quote, absent also is so-called forward guidance.
Which, for anyone managing capital right now, is terrifying. We need to define exactly what was lost there, because since basically 2003, the Fed has actively telegraphed its rate moves to Wall Street.
Right, they handed traders a roadmap. You could price in the cost of capital 6 to 12 months in advance.
And Warsh just ripped up the roadmap. It's like driving at 100 miles an hour while someone throws a blanket over your GPS.
That's exactly what it feels like. And he did it at the exact moment the macro data suggests the market is looking the wrong way. Just look at the briefing on yesterday's May JOLTS report.
The job opening survey.
Yeah. It showed an unexpected jump in openings to a 2-year high of 7.594 million.
Let's unpack the mechanics there. For anyone who just brushes past the JOLTS print, why does a surge to basically 7.6 million open roles severely limit the Fed's ability to cut rates?
Well, when there are that many unfilled jobs, corporations have to aggressively fight for scarce labor. So HR departments start poaching talent by offering like 10 or 15% premiums on base salaries.
And that worker takes the extra cash and spends it in the real economy.
Right, which allows retail companies to keep their prices high. It creates this self-sustaining wage price inflationary loop. Pair that stubbornly tight labor market with Warsh's explicit new mandate.
Which is strictly price stability.
Exactly. He said, quote, the committee will deliver price stability, period. He is not mandated to protect your S&P 500 portfolio from a drawdown.
But hold on, the equity market has spent the last 6 months aggressively pricing in rate cuts. Investors have been salivating over cheaper money.
Which is why we're walking into a trap.
Right, because if we have sticky inflation from Middle East oil, 7.6 million job openings driving up wages, and a Fed chair demanding price stability.
The math completely inverts.
Exactly. The briefing shows bond futures are now pricing in a greater than 85% probability of a rate hike later this year. 9 out of 18 policymakers are actually projecting rate increases in 2026. So why hasn't the broader market completely crashed yet?
Because of the pain trade. I mean, retail investors have 15 years of ingrained muscle memory telling them to just buy every single dip in tech. They assume the Fed will always step in to save them.
But institutions are looking at a double-barreled macro headwind that is specifically engineered to squeeze tech valuations.
Let's break down those two barrels, starting with the yield drag.
Right. The 10-year Treasury yield had a sharp 10 basis point spike overnight.
Yeah, it's hovering around 4.46 to 4.47% right now.
For a trader who strictly watches the Nasdaq and ignores the bond market, why does a 4.47% risk-free yield actively force a sell-off in profitable tech companies?
Because high multiple growth stocks are long-duration assets.
Hmm.
Think of a mega-cap tech company like a commercial farmer planting a massive apple orchard.
Okay.
They are pouring billions of dollars into AI research today. But the massive windfall of profits won't actually materialize for maybe 10 or 15 years.
So when you value that company, you have to discount those future profits back to today's dollars.
Right, and the 10-year Treasury yield is that mathematical discount rate. If you can earn a guaranteed risk-free 4.47% simply by loaning your money to the U.S. government for a decade.
The cost of waiting for that tech company's orchard to produce apples gets incredibly expensive.
Exactly. A higher yield aggressively shrinks the net present value of those future earnings. It's mathematical gravity.
So the yield acts as a strict valuation penalty. And compounding that is the second barrel of the headwind, which is the strong U.S. dollar. The DXY is breaking out to 101.35 this morning.
Meeting a 13-month high.
Right. So walk us through how a strong dollar structurally taxes these tech giants without them ever changing their business models.
It acts as an invisible tax on foreign revenue. Say a U.S. tech giant sells an enterprise cloud license in Europe for 100 euros.
Okay.
Last year, when the dollar was weaker, they took that 100 euros, converted it back to U.S. dollars for earnings, and got 110 bucks. Today, because the dollar index is spiking, that exact same 100 euro sale only converts back to $95.
Wow, so they didn't lose a single client, product didn't change, but global revenue just evaporates in the conversion.
Completely evaporates.
Yeah.
Which explains why institutional capital is reading the room and pricing in a violent valuation reset. They are quietly rotating out of unhedged growth stocks.
But capital never just vanishes, right? It moves. And looking at the sector flows, the smart money is finding shelter in the industrial sector. The Industrials ETF, ticker XLI, is up roughly 7% over the past month.
And that rotation directly links back to the geopolitical tensions we just talked about.
How so?
Well, nations and corporations are waking up to the fact that the global supply chain is fundamentally unstable. That threat in the Strait of Hormuz triggers this immediate realization that you have to build physical infrastructure domestically.
Right. So we're seeing massive CapEx acceleration for next-gen metallurgy, defense build rates, and physical power grids. Wait, this is where it gets really interesting regarding the AI boom.
Oh, absolutely.
Because for the last 18 months, the AI narrative was purely software and silicon.
But you can design the most advanced GPU cluster on the planet, and if the local utility grid cannot physically deliver the 500 megawatts required to cool that data center,
your cutting-edge software is entirely useless.
it's a paperweight. The bottleneck for AI is no longer code. It's physical infrastructure. You need thousands of miles of heavy copper wiring, industrial liquid cooling, and tired new power plants.
You cannot engineer your way out of needing basic electricity.
You really can't. That is why capital is flooding into heavy machinery and industrials. They are the physical picks and shovels of the AI gold rush.
Let's zoom in on how this macro squeeze is breaking down at the ticker level in the pre-market. We have three specific gappers reacting to these constraints, and they paint a picture of a really abnormal retail landscape.
Very abnormal.
Let's start with Nike, ticker NKE. Shares are down 3.51% pre-market, sitting near 41 bucks. Now, the headline numbers look fine. They had a massive EPS beat of 72 cents and beat revenue at $10.97 billion. So why the brutal pre-market dump?
Because institutional algorithms scan past the headline. Nike's underlying mechanics are failing. That 72-cent beat was heavily engineered by a one-time 52-cent recovery of import tariffs.
Oh, wow. So it's basically a paper beat.
Totally. It masks a severe organic drop in demand. Nike direct sales, which is their core consumer metric, dropped 7%. Greater China sales plunged 17%.
And CEO Elliott Hill even warned about an abnormal retail landscape on the call.
Right. It's a margin-first recovery on the balance sheet, but top-line growth is stagnant. It proves you can't just cut costs and engineer an EPS beat if the consumer is actively rejecting a $150 sneaker.
Which brings us to the exact opposite scenario. Constellation Brands, ticker STZ, gapping up 3.2% pre-market to roughly 143.59.
Yeah, Constellation delivered a huge Q1 double beat. EPS of $3.43, revenue of $2.43 billion, But the real story is the structural resilience of their beer portfolio.
The Modelo and Corona lines.
Exactly. In a macro environment where every other brand is crying about supply chain costs and shrinking margins, Constellation managed to drive their operating margins up sharply to 34.7%.
34.7% margin on beer. Given the inflation data we just covered, that's incredible. It tells us pricing power absolutely still exists if the product fits the consumer's psychological budget.
Right, a consumer feeling the pinch of 4.47% interest rates will delay buying the new Nike shoes, but they absolutely will not sacrifice their premium weekend beer.
It's ruthless consumer prioritization. Okay, let's look at the third pre-market mover, which highlights a completely different mechanism. TOST, ticker TOST. Shares are soaring over 4% to 25.50. They didn't even release an earnings report, so why the massive gap up?
Toast is experiencing a structural liquidity event. Today, they are officially replacing top build in the S&P MidCap 400 index.
Let's unpack index inclusion for a second. The company isn't selling any more restaurant software today than they were yesterday, but the stock is flying. Why does simply being added to a list force the price up?
Because of passive ETF and mutual fund rebalancing. There are billions of dollars sitting in funds that are contractually obligated to perfectly mirror the S&P MidCap 400. So the second Toast is officially added. Every single one of those fund managers must mechanically purchase millions of shares on the open market. It creates an indiscriminate wall of buying pressure.
Regardless of the stock's valuation. But it is crucial to note this mechanical bid is meeting actual fundamentals. Toast's GAAP operating margins just crossed the 20% milestone.
And that is GAAP accounting. Fully loaded, heavily audited financial reality.
Not the adjusted non-GAAP fantasy numbers tech companies use to hide their stock-based compensation.
Exactly. So passive funds are buying a company actually executing on profitability.
Which brings us to the operational reality for the trading day. With this intense macro backdrop, we have to define the exact parameters of the playing field. If we are flying without Fed-forward guidance, the technical levels on the charts become our only definitive guardrails.
We absolutely need those lines in the sand.
Let's look at the S&P 500 futures, the /ES, currently trading around 75.22 pre-market. The source material draws a hard line at the 7,500 pivot. Why is 7,500 the structural control level today? Is there actual institutional weight there?
Massive weight. It's heavily driven by options dealer positioning. There's a huge concentration of put options sitting exactly at the 7,500 strike price.
Okay, so if the index breaks and holds below 7,500?
The market makers who sold those options are suddenly at massive risk. To mathematically hedge their books, those dealers are forced to short the underlying futures.
That delta hedging just creates a reflexive loop of selling pressure.
It severely accelerates the drop. If the bears establish control below 7,500, the next major macro support doesn't even kick in until 74.46.
Wow. And for the bulls to negate that risk, they have to push the implied open higher and reclaim immediate structural resistance at 75.49.25.
Right, flip that to support, and you could attempt to break out toward all-time highs.
Got it. And on the Nasdaq 100 futures, the /NQ, we're currently around 30,362.50. The pivot here is 30,500. Staying below that ceiling severely caps any intraday momentum.
And the danger zone.
Key structural support is at 30,276. If we lose that level, the briefing warns of a liquidity vacuum straight down to the 30,000 floor.
So the ultimate strategic verdict for today's session is extreme caution. We are stepping into a pre-holiday, low-volume liquidity trap.
And when volume is light, price action gets highly erratic.
Exactly. The directive is to keep your position sizes scaled down. Do not chase early gap-and-go momentum trades until the ADP employment data, the ISM manufacturing numbers, and crucially, Chair Warsh's centrist speech are fully absorbed.
Let the institutional data drop before you commit your capital. You really have to know when to sit on your hands. I mean, we've covered a tectonic macro shift this morning. The market is transitioning from a euphoric Q2 into an incredibly tense data-dependent Q3.
We are navigating renewed geopolitical threats, the sudden death of the Fed's forward guidance roadmap, and a painful rotation out of tech into heavy industrials.
If your portfolio is exclusively positioned for zero interest rate tech growth, you are playing by the rules of an era that officially ended yesterday. So review your biases.
And, if we pull back to the absolute highest macro view, it leaves us with a fascinating dilemma.
Lay it on me.
We spend so much time discussing how traders and fund managers are struggling to price assets without the Fed holding their hand. But consider the CEOs of the companies we just analyzed.
Right.
If the central bank is permanently turned off the radar, and literally no one on Wall Street knows where the base cost of borrowing money will be in 6 short months,
Yeah.
how do those corporate boards even begin to plan and execute a decade-long capital allocation strategy for, say, a $5 billion AI data center?
Oh, wow. You literally cannot safely construct a 10-year physical asset when you have zero visibility on the 6-month cost of capital.
You really can't. The roadmap is gone.
The roadmap is gone, the data is contradictory, and the market is officially forced to navigate the storm on its own. Review your exposures, respect the technical lines in the sand, and trade the market in front of you. That is the bell. Stay sharp out there.